across the country. I do want to help get some sense of the SME industries. What's the outlook that, what do you think is the outlook in that space? What's the commentary that's coming in from that industry? And also, how is the Tier 3 and Tier 4 city market performing at this juncture?
So on the overall, if you see, small and medium enterprises are doing better after the 2-3 jolts of different kind of problems that has happened, whether it is demonetization, GST implementation, or COVID wave 1 and wave 2. Now I think they are all looking forward to good business, which is seen in the last year FY23 and first half of FY24 also. Given that the micro enterprises, which are still struggling, which are especially the ones which are below the GST registration. As you know, we have about, with any estimates, we have about 60 million plus SMEs in the country. However, there are only 13 million or so which are GST registered businesses. That leaves out almost 80% of the micro SME base out of the GST base. They are still finding it hard to adjust to the new GST regime because they are feeling left out a little bit. So we should look at how to include them better in the overall scenario. I have a lot of expectation from account aggregator framework and OCEN framework so that they can be included in the formal credit network sooner than later. And also expecting the interest rate to come down a little bit as the repo rate has been at the highest level in the last couple of years. So we are also expecting some interest rate relief to come in the next year or so. Having said that, I think the Tier 3, Tier 4 SMEs have always have this problem of a smaller market and opaque price gains, sure, which is now not possible in the era of internet where every prices are available at a click of a button. So they are definitely feeling some pressure.
Right. Point taken, sir. But unfortunately, that's all the time we have today. Of course, larger conversation with regard to your numbers is warranted. The stock is up 5.5% odd, and we'll try to have you back. But, I want to very quickly move to the other stock which has reacted sharply to earnings, and that's a Nifty 50 stock, IndusInd Bank, down 3%. Now, just to try and break the numbers down, what's happening there, Mimamsa joining us with the key takeaways with regard to IndusInd Bank, as well as, Mimamsa, if you can also throw some light with regard to what brokerages are saying.
Yeah, hi Hersh. So, IndusInd Bank reported 17% rise in its net profit, which was in line with what analysts were expecting. But the point of concern that most brokerages are highlighting is that the slippages that they reported this quarter was a little higher than what was expected. So they reported gross slippages at around 17,000 crore, and they were expecting 14,000 crore, 1,400. I'm so sorry. 1,700 crore was the gross slippage number that they reported, and the expectation was 1,400 crore. So management has said that they're working on recovering this account, but what the employees, what the analysts are saying that that because they have deployed contingent buffers, the credit cost was at 1.2% in the December quarter. Otherwise, the core credit cost was higher, and the bank noted that it could not build new buffers. So another bit that is interesting here is that the IndusInd Bank has not provided for its exposure to alternative investment funds as they're looking to sell these holdings. So the key focus area for the next quarters will be the slippage number and how much the provision the bank would set aside and what the credit cost is going to be. So provision, the analysts are saying that the bank will have to add provision buffers and will have to look to lower down their credit costs.
Thanks a lot for that, Mimamsa. The IndusInd Bank stock down about 3% in today's trade. But moving on, CE Infosystems, the parent company that owns MapmyIndia, has recorded a 400 crore rupees order win, which includes business contracts for Hyundai and Kia cars. Anushi joins us with more on that.
Right. So MapmyIndia has just recorded a 400 crore of order win for the Hyundai and Kia cars, as you mentioned. The stock did see about a 5 to 6% odd gain about that, but now it has cooled off from those early day gains and now coming back to like 2% odd gain right now. So that is on the order win that is happening. But just a few days back, it also came out with its Q3 FY24 numbers, wherein it recorded about a 1% growth in its revenue at 92 crores, while its EBITDA and margins did take a beating, with the EBITDA being down about 11.8% and margins being down about 571 bips at 39.2% compared to 44.9% it had recorded last year. With this, now the open order book details are not there for the current mix. FY23 open order book stood at about 918 crore. The company did highlight in its latest report that the future guidance is of achieving a revenue milestone of 1,000 crore by FY27 to 28, which implies about a 35 to 40% CAGR growth. So that's all on MapmyIndia for today.
Thanks a lot for that. Meanwhile, it's time to slip into a very short break. Stay tuned. We'll be right back.
Welcome back. You're watching Market IQ on NDTV Profit. At the bottom of your screen, you can see UltraTech's Q3 numbers, which have just come through. You're largely seeing the revenue number in line with what estimates were indicating, as well as the EBITDA number also slightly below, but largely seems to be in line, at least at the moment. The stock saw a bit of a spike, has now cooled off immediately. It looks like you are seeing a largely inline set from the numbers coming in from UltraTech. But let's quickly look at some voices coming in from the World Economic Forum 2024 at Davos. Our editor Neeraj Shah caught up with Anish Shah, who's the group CEO and MD of Mahindra Group, questioned him about the global leaders and about what global leaders and CEOs have to really say with regard to his sector. Listen in.
I must say that the view on India is very positive across the board, and the India delegation has done a great job in portraying India extremely well and more realistically also. India stands out in the world as a shining star at this point in time. A number of CEOs who I've met over the last few days are keen to know more about India. Some who are not in India want to come to India. Those who are there are looking to expand further. And it's therefore a very positive place for us to be.
Yeah, so that's what I would love to know, because for everybody who's been here, the promenade shows the state pavilions, company pavilions, etc. What is not known is the kind of conversations that are happening. And you made an interesting point about CEOs not present wanting to come to India and CEOs already present wanting to deepen their presence. Give us a flavor of that.
I think there are a few things driving it. First is India starting to stand out as a destination for supply chain. In some cases, it may be a de-risking from China. In some cases, I think it's more India standing on its own as an attractive place to be. The second is the India market. I think people are starting to see that now. The consumer in India is growing rapidly. Consumption is going to grow significantly. There is a concern in people's mind as to how do we compete in India. We've seen
locals, you mean? Oh.
We've seen foreign companies succeed in India and do very well, and we've seen foreign companies not succeed in India. And so therefore it's rightly a question in their mind saying, what are the lessons we learned from folks who've been there in the past? And how do we learn from folks who succeeded there and come in there and do that? So I think they're thinking about it the right way, but they're thinking about it as a place for supply chain. And
now, our colleague also had the chance to speak to Tech Mahindra's MD and CEO, Mohit Joshi. Listen in to a slice of that conversation as well.
It's a very powerful technology, right? And obviously it has evolved over time. And so what we had earlier was machine learning, and what we have now is a more powerful tool that allows us to converse almost in natural language through GenAI. It is a powerful tool. What we have to do is we have to figure out the use cases for the underlying technology, because for most businesses, the transformation that they want to drive is through use cases, right? And I feel that three clear use cases are emerging for the use of AI. The first use case is very clearly from a contact center perspective, right? Or a digital deflection perspective. Can I understand before you call a contact center about what you want, right? Can I, instead of having an agent speak to you, can I have a chatbot speak to you? And I think for a contact center sort of rep as well, to be able to understand your requirements perfectly, to be able to anticipate your needs, I think that's a very powerful use case. I think the second very powerful use case is from a talent perspective, right? How do we look at the talent that we have within an organization? How do we look at the talent outside? How do we do skilling at scale? How do we do hiring at scale? How do we figure out what people are best at, right? How do we make the best use of them? I think that's a second very emerging powerful use case that we're seeing. And the third use case, which is the one everybody is talking about, is about developer productivity. A lot of programming, a lot of testing, a lot of design can automatically become, can become automated, can become more intuitive. So these are the top three use cases, but clearly there are millions of use cases, right, for every industry. There are anti-money laundering and client onboarding use cases for banking. There are, field services and network monitoring and, energy usage use cases for telecom companies. There are computer vision use cases for, auto companies. And so a confluence of use cases that can help drive, greater productivity, higher levels of sales, better customer satisfaction.
Right. So that's all the voices coming to you from WEF at Davos. But, let's quickly have a look at what markets are doing before, we wrap up this show. We're looking at around 0.75% thereof of gains on where you're looking at the benchmarks. The Nifty itself up roughly 0.75% odd. You're well above the day's low, which was at around 21,550. Therefore, you're 70 odd points above that. So you're comfortable, at least at the moment, the way the benchmark is looking. You're looking at even broader markets doing fairly well. You're seeing the Nifty mid-cap and small-cap both 1% plus higher in trade. Let's look at the advanced decline, which will continue to indicate that the trend is it's a buyer's market right now. We're looking at a good buying coming through. Advanced decline is roughly 3:1 in favor of the advances. The breadth looks quite good. You're looking at across sectoral indices as well, except Nifty Media, which seems to have slipped into a zone of its own, down around 0.5%, continuing to stay there with probably just two losers on the Nifty Media, just opening that up. Yeah, just three stocks in the decline on the Nifty Media. You're seeing 4% down on both Z and Dish. Outside of that, you're seeing good positivity across sectors coming through. So it looks like a good day of trade. But with that, we're completely out of time on this edition of Market IQ. You're watching NDTV Profit. Continue to do so. More on the other side.
Hi, thanks so much for joining in. This is the Mutual Fund Show on NDTV Profit, and I'm Alex Matthew. Often in the construction of your investment portfolio, a lot of attention goes towards choosing the right equity mutual funds, and not enough attention is paid to fixed income. The thing is, you can use a fixed income portfolio very effectively, not just to meet your shorter term goals, but also in asset allocation strategy. And in certain situations, you can make a tactical allocation to make significant capital gains. That is what we're going to be talking about on today's program. We'll first talk about the current context, and then we'll move to strategy. My first guest is Pankaj Pathak, Fund Manager and Fixed Income at Quantum EMC. Thank you so much, Pankaj, for taking the time. Let's set the context for everybody that's tuning in. There's a lot that is happening in the bond markets globally. So as a fund manager, what are the key triggers that you're focusing on, not just in India, but on the global stage?
Thank you, Alex. Thank you for having me. So first of all, last 2 years, or I would say 3 years, have been difficult for the fixed income market globally, especially given the inflation, which has spiked after COVID, and there all this geopolitical situation where there's been war between big commodity exporters. And what we saw that globally central banks were hiking interest rates. India too had an inflation of its own, and RBI was also hiking interest rate till early part of last year. So last rate hike was in February. So overall, 2022 was very bad. 23 we had a decent year despite all the negative news flows, negative developments on the macro front. But now entering into 24 with a very favorable backdrop. Now the macro backdrop has completely changed. What we see now is that central banks have kind of stopped their rate hiking cycle. Most of them have already indicated that rate hiking cycle is almost done. And probably they will start rate cutting cycle. So some are explicit about it, some are not indicating the rate cut. But broadly, we can understand that monetary policy cycle is somewhere around the inflection point where we'll probably see rate cutting start sometime in by mid of this year. Apart from that, we had a big fiscal stimulus after COVID, and the lingering effect of that was there in the economy and in the bond demand supply till now. And we have some sign of that fading away as government, especially in India, have been consolidating their balance, their fiscal balance, and also on the demand side, which has grown, and we don't need that kind of RBI support what we needed just 1 years back. So on both the fronts, and so domestically, inflation, fiscal, and the external environment, these are three major drivers, and in all the accounts, things are kind of flashing green for now for the bond market, especially for the longer duration bonds, which are more dependent on interest rate cycles, and when interest rates move up, they kind of suffer. So last 2-3 years were bad. Now we have a very favorable backdrop where we'll probably see interest rates coming down this year, and that could be a positive driver for long duration bonds and funds which are investing in these kind of bond, long duration.
Okay, so you've kind of set the context, but then I also want to delve a little deeper into that last statement that you made, which is about the long-term paper and that being favorable, essentially long-term bonds and duration. Now, we are at 7.2% on the 10-year bond right now, the government benchmark bond. We have, and in several geographies, in several markets, already seen bond yields come off quite substantially. I think from close to 7.4% levels earlier, we have come down to 7.2% or thereabouts, and we've hovered around this mark. The question is, how much is already being priced in, and how much of a downside is possible over the next 1.5 years? What are your own expectations about the trajectory of the 10-year and the longer paper?
Yes. So as I said, we have three major drivers of bond market flashing green. Now, the valuation in the bond market depends a lot on the interest rate cycle. Now, one way of value a bond, especially the long duration bond, is to look at the spread between the between the bond yield and the policy repo rate or the overnight funding rate, etc. So just to compare between the repo rate, which is at 6.5%, and the 10-year bond yield, which is around 7.2%, the spread is around 70 basis points. One would argue that this spread is below its long-term average. If you take, say, 10, 20-year average, you'll probably find the spread between the 10-year GSEC and the repo rate somewhere around 100 basis points. But when you just look at the cycles where interest rates are in a declining phase or interest rate cycles have peaked, most of the cases you find this spread between the 10-year GSEC and the repo rate much narrower, somewhere around 30 to 40 basis points. So there is a strong case for the spread between the long-term bond and the repo rate to top risk. That's one. Secondly, we have seen inflation coming down sharply. With the headline numbers might overestimate because of the vegetable price cycles that has been distorted. We have not seen that kind of drop, what we usually see in December. And there has been some spike in different vegetables from time to time that kind of distorted the inflation cycle. But if you look at the underlying inflation trend, ignore the volatile vegetable prices, or just for sake of ease, we look at the core inflation, which includes the food and fuel prices, that has come below 4% recently. And if you look at the momentum, which is month on month, how it's growing on month basis, and try to analyze that, probably we'll see core inflation falling somewhere close to 3.5% in the next few months. So there is also a case for rate cut. Some of the MPC members have already